Let's talk about a concept that is crucial for any business, whether you're running a small online shop or managing a large corporation, the cash conversion cycle, or 300 for short. Now, I know what you might be thinking. Cash conversion cycle. Sounds boring. But stick with me, because understanding this metric can be a game changer for your business. So, what exactly is the cash conversion cycle? In simple terms, it's the time it takes for a company to turn its investments in inventory and other resources into cash. Imagine this: you buy a bunch of products, you sell them, and then you wait for your customers to pay you. The 300 measures the time from when you spend money on inventory to when you finally receive cash from your customers. It's basically the heartbeat of your business's cash flow. Now, why should you care about the 300? Well, the shorter your cash conversion cycle, the better. Why? Because a shorter cycle means your cash is moving through your business more quickly. You can reinvest that cash into new inventory, pay off debts, or even take your team out for a celebratory lunch. On the flip side, a longer cash conversion cycle can lead to cash flow problems, which can be detrimental to your business. Nobody wants to be in a situation where they can't pay their bills because their cash is tied up in inventory or waiting for customer payments. The 300 consists of three main components: the inventory conversion period, the accounts receivable conversion period, and the accounts payable conversion period. Let's break these down a bit. First up, the inventory conversion period, or ICP. This is the time it takes for a business to sell its inventory. You want this period to be as short as possible. Think about it: if your products are just sitting on the shelves, that's cash you can't use for anything else. You need to find a balance. Having too little inventory can lead to missed sales, but having too much can tie up your cash. Next, we have the accounts receivable conversion period, or ARCP. This is the time it takes for your customers to pay you after making a purchase. Ideally, you want your customers to pay you as soon as possible. The quicker you can collect those payments, the sooner you can reinvest that cash back into your business. If your ARCP is too long, it might be time to reevaluate your credit policies or your collection processes. Finally, there's the accounts payable conversion period, or APC. This is the time it takes for your business to pay its suppliers. Now, here's where it gets interesting. You want to stretch this period as long as possible without damaging your relationships with your suppliers. If you can delay payments, you're holding onto your cash longer, which is great for your cash flow. But remember, you don't want to push your suppliers too far. They're your partners in business, after all. So, how do you calculate your cash conversion cycle? It's actually quite simple. The formula is 300 equals DIO plus DSO, DPO. DIO stands for days inventory outstanding, DSO for days sales outstanding, and DPO for days payables outstanding. Each of these components gives you insight into how efficiently your business is operating. Let's dive a little deeper into how to calculate each of these components. For days inventory outstanding, you take the average inventory and divide it by the cost of goods sold per day. This tells you how many days, on average, your inventory sits before it's sold. For days sales outstanding, you take the average accounts receivable and divide it by your daily revenue. This shows you how long it takes, on average, for your customers to pay you. Lastly, for days payables outstanding, you take the average accounts payable and divide it by your daily cost of goods sold. This tells you how long, on average, you take to pay your suppliers. Now, once you have these numbers, you can start to make informed decisions about your business. If your cash conversion cycle is longer than you like, you can take action to improve it. This could mean tightening up your inventory management, speeding up your collection processes, or negotiating better payment terms with your suppliers. But remember, the 300 isn't just a number to chase. It's a reflection of how well your business is managing its resources. A shorter cash conversion cycle often indicates that a company is operating efficiently, while a longer cycle can signal potential issues. It's crucial to track your 300 over time and compare it to your competitors. If you notice your 300 getting longer, it's time to investigate why and make adjustments. Let's talk about some practical ways you can improve your cash conversion cycle. First, consider implementing an efficient inventory management system. This can help you avoid overstocking or understocking, both of which can tie up cash. You want to keep just enough inventory on hand to meet demand without letting it gather dust on the shelves. Next, think about your billing and collection processes. Are you sending invoices promptly? Are you following up on late payments? Streamlining these processes can significantly reduce your days sales outstanding. You might even consider offering discounts for early payments to incentivize your customers to pay faster. When it comes to your suppliers, don't hesitate to negotiate better payment terms. If you can extend your days payables outstanding, you'll have more cash on hand for other expenses. Just remember to maintain a good relationship with your suppliers. You don't want to jeopardize future orders over a late payment. Now, let's address the elephant in the room. What if your cash conversion cycle is negative? Yes, it's possible. A negative cash conversion cycle means you're collecting cash from customers before you have to pay your suppliers. This is often seen in businesses with strong sales and efficient collection processes, like some e commerce companies. While a negative 300 can be ideal, it's not something every business can achieve. Instead, focus on reducing your 300 sustainably and benchmarking against your competitors. As we wrap up, I want to emphasize that understanding and managing your cash conversion cycle is essential for your business's success. It's not just about numbers, it's about ensuring you have enough cash flow to operate smoothly and invest in growth opportunities. By keeping a close eye on your 300, you can make informed decisions that will benefit your business in the long run. So, whether you're a seasoned entrepreneur or just starting out, take the time to calculate and analyze your cash conversion cycle. It might just be the key to unlocking your business's full potential. Remember, cash is king, and the quicker you can convert your investments into cash, the better position you'll be for success. Keep that cash flowing,